Hello and welcome to this podcast from the private wealth team at Safri. My name's Leonora Stevens. I'm a partner in the private wealth team based in Bristol. I'm delighted to be joined virtually by Mike Hodges, a fellow private wealth partner at Safri who's based in Manchester. Hello, Mike.
Hi, Leo.
Today we are talking about gifting and the tax considerations, in particular as the festive season is around the corner. We are recording this at the end of November, so the decorations seem to be going up around us and it is beginning to feel a lot like Christmas. Although I might say decorations don't go up in my house until the 1st of December.
We've got decorations up, and I had my first Christmas sandwich at lunchtime yesterday, so that's my confession.
Very good. Well, clients tend to make various gifts at different times of the year, but we felt that with Christmas looming and the sort of the festive cheer and goodwill, plus following the budget in October, the gifting might be slightly higher on people's agenda. And so in this podcast, we'll discuss the tax implications and the areas that you should be mindful of. So Mike, do you want to cover off the initial tax implications of making a gift, whether it's cash or an asset, and cover the capital gains tax and inheritance tax implications?
Yeah, by all means, I'll just do a quick whistle-stop tour. So capital gains tax, starting at the simplest, if you're giving away cash, that's simply not an asset for capital gains tax So as much cash as you want, or as little cash as you want, and gifts between husband and wife, between spouses on a no gain, no loss basis. So you can forget capital gains tax there. If you're then looking at other assets, you do need to think about the capital gains tax implications, because you may feel as if you're making a gift, but caveat capital gains tax. And there was a case, I've tried to look it up, but I can't find it, of someone who represented himself and had given assets away and represented himself all the way to the Court of Appeal saying, because I gave assets away, there cannot be any capital gains tax, can there? And the Court of Appeal had to say, well, no, sorry, you're wrong. So that's just a little word of warning. So you get nothing in return, it is a gift. But if it's a non-cash asset, you have to think about CGT implications, and clearly we'll be happy to advise on that. And don't forget, rates went up in the budget. So 18% to 24% are the new main rates of capital gains tax. And if you're making a gift with no proceeds coming in, then you've got what we would call in the jargon a dry tax charge. So a tax charge with no proceeds. And we can talk a bit, because there are some class of assets that CGT position slightly different, but we'll come back to those in a minute. And then if you're saying, right, I'm actually clearing out, I've got these assets, I paid a fortune for them, they're now worthless. So you make a loss on your disposal. That loss isn't something you can use generally against other gains. You can only use that loss against gains on assets given or gains made with the same person. So it's not a terribly helpful loss to have. So that's the basic capital gains tax position. Inheritance tax, and we'll come back to the budget, because we're going to be talking about the budget for years, aren't we? And we were talking about doing another podcast on that, so we may well do that. So I think everyone is aware that one thing that didn't change in the budget is this 7-year rule. If you give an asset away, you survive 7 years, it's outside your estate for inheritance tax purposes. I guess the one caveat, and I think I've only seen one post-budget commentary on this, is my least favorite tax acronym, which is the GROB regime, which you can't give away an asset and continue to enjoy it. So you can't have your cake and eat it. And if you do, it stays in your estate and you may only be getting a fractional benefit from it. So, we're getting a bit beyond Christmas gifts, but a holiday home, and you have a long weekend there each year that you don't pay value for, then that asset is still in your estate. So 7-year rule, people are clear on. Perhaps they're not as clear on this gifts with reservation set of rules. And then going back to the more modest gifts, and an exemption for inheritance tax of £3,000 per year. And if you haven't used last year's, you can bring that forward for 12 months. And small gifts of £250 per person per year. So that's sort of, as I say, the whistle-stop tour. I'm going to ask you a question in a minute on IHT, but one question that I was asked for the first time ever last week was a couple living together. One has quite a lot of wealth, the other one doesn't. Could gifts from one to the other be income? And I said, no, because what we're talking about here is capital, and gifts are never going to give rise. Well, I say never, but I shouldn't use that term in a tax context, otherwise I'll be held up. But normal gifts between individuals are not going to create a stream of income because there's nothing enforceable. You couldn't say, right, I'm suing for that. So
Unless there was some kind of contract in place, but that's
yeah.
unlikely between a husband and wife. Well,
Yeah, and this was
married.
an unmarried couple, so I hesitate. And when I said never just a second ago, the minute you say never, you think, oh, hang on, could there be an exception? But I would think it'd be very rare that you could create a situation where gifts from one individual to another became income, so they would be taxable as income in the hands of the recipient. I think that would be vanishingly rare, the situations that would rise. You're looking at
No. I was just thinking that
that.
if one could generate an income from say, a wife giving an income to the husband in gifts, then you could look at, they would then think about whether that would be treated as relevant income for pension purposes. So,
Oh,
yeah, I
goodness.
think that sounds like unlikely scenario.
Very unlikely. In the meeting I had, I just said, no, that's not a problem, move on. And I think that's right, that gut instinct.
Yeah, I agreed. But also, following on from what you were saying before, the important thing is birthday and Christmas gifts that people give are normally treated out of your regular income, so they're exempt from
Yes.
inheritance tax. So
Yeah.
obviously, depending on the size of the Christmas gift, which well, I suppose it wouldn't really count if I asked my husband for a large Christmas gift, because from interspouse wouldn't matter. But there is also the IHT exemption, as you briefly touched on, about regular gifts out of surplus income. And I
Yes.
think we cover this several times in our podcast because it's such a valuable benefit. And so this is where, to recap, you can make regular gifts to individuals out of your surplus income, and that gift would be outside of your estate for inheritance tax purposes. So no IHT due if you were to die within 7 years. So if you think you might have surplus income, then this is a great exemption that you should really consider further. Another point that some people might forget about is that, or you need to be wary about, is if you are making large gifts to your children, and if your children are minors and more than £100 of income is going to be generated from that gift that you've given them, then that income is actually taxable on the parent. So it's sort of commonly seen where parents think they have a bright idea and think, oh, it would be much more tax efficient for their children to hold some of their wealth because they'll have minimal other income sources. So they benefit from the lower tax rates, personal allowances, etc. But this legislation is sort of intended to stop that. So because, as the income is actually taxable on the parent anyway. But that's one thing that other grandparents might want to think about, and why it's beneficial is that if grandparents make a gift to the grandchildren, and then those gifts aren't caught in the same way. So if a grandparent gave a grandchild a large gift, the income was over £100, it would all be taxed on the grandchild. So that sort of works that way. But in a way, from an inheritance tax perspective, that's good, skipping a generation anyway. But Mike, we spoke briefly about mitigating the capital gains tax on gifts. Do you want to talk a bit about holdover and the impact of the recent budget?
Yes. So holdover in concept is saying, going back to the point I made earlier about give an asset away, a non-cash asset, you need to think about capital gains tax. If you have certain business assets, then the holdover rules say, well, you don't have to pay the tax on that gain now. You can effectively give the asset and give the gain to the recipient of the gift. So in other words, the recipient inherits your tax base cost, and only when they ultimately sell the asset do they pay the tax during their period of ownership and yours. So that's quite useful. So if you're talking about everything that we've been covering since the budget around business type assets, and also there's a particular scenario where you're putting assets into trust because that gives, again, a holdover opportunity. And in the context of the budget, because we're now in this situation where agricultural property relief and business property relief from April 2026 are going to have this £1 million ceiling, which has seen farmers protesting earlier this week on the streets of London, led by or including Jeremy Clarkson and various celebrities. So that's where it'll be in people's thinking. That is making us as practitioners and the wider sort of people affected think about giving assets away before they die. So rather than in their will, make a gift early enough they hope to survive the 7 years, and that still applies. And in fact, I have a subscription to one of them broadsheet newspapers, and they made great play with the headline again earlier this week of Steve Reed, the Environment Secretary, actually giving that advice to a farming family. I think he gave a speech, didn't he? We had a transcript circulated yesterday, and as part of that, he was talking to this farming family and himself gave the advice. And then on this particular subscription, I love clicking down to the comments. And one of the comments is, I've been a financial advisor for many decades, and I hope he's regulated by the FCA. Otherwise, someone should be taking him to task for giving planning advice in that kind of context.
But that also giving it away now from a farming enterprise, for example, from what you said earlier about the gift with reservation of benefit, if you give it away
Absolutely.
too young, then how are you going to be funding? If they're in their 60s, then they've got quite a long time to go still. So they obviously can't benefit from that asset anymore.
No.
It's how that weaves in with the tax planning versus actually having any income to live off.
And I guess that's why government ministers would probably be best advised not to give tax advice, because absolutely it's very easy to say give the asset away, and that might, in a very, very narrow tax context, be the right answer. But you've got to think about everything else. You've got to think about, or what income does the donor then live on? If it's a farming type asset or a business asset that they've been taking income from, they've suddenly given away that source of income. I was asked in the run up to the budget, when lots of people were thinking about what the changes might be, I've got an asset, should I give it to my children? And I said, well, that's not just a tax question. First of all, are you comfortable giving that asset away? Because that's it, it's gone. You can't sort of lend it and take it back. Otherwise, the value's still in your estate. So it's a far wider discussion and far more issues to consider than just giving a asset or assets away for inheritance tax purposes, because that's only part of the question. So I think we're just at the start, we've been saying, of the whole thought process of what's the best solution, and it's going to vary family by family, control of businesses, the gift with reservations, a whole host of issues, and there's not going to be a one size fits all answer. So
I think liquidity will be with all of these things will be an issue. And I feel that we're, with respect to this of making gifts now or on death and the inheritance tax, everyone's talking about the farming entities, but we're not necessarily looking at a normal trading company which has got, family shareholders, and where's their cash going to come from? How is the cash for the tax going to be funded? I mean, I suppose we're slightly digressing here from the
we'll get from
gifting.
Christmas.
Gifting
We
at
lost the
Christmas.
Christmas spirit, yeah.
But I do think with sort of APR and BPR, it's key with all these things and everything that we advise is start the conversations early and
Yes.
just try and understand what the motives are for each of the members of the family, looking at control, succession, how much do you want to give away? And communication is key to all of this, to try and sort of demystify the tax. But as you said, it's not all about the tax. It is also about what's going to make people happy. Obviously, I know what certain clients what would make them happy if there was a change in the rule back to what it was, but who knows whether that's going to happen. But ultimately, we're advising people to just wait now for the consultation to come through early next year.
Yeah.
And then we can fully assess the impact, and then we can try and work through people's action plans and objectives and see where we can get to in the most efficient way.
Yeah. Tempting as it is to launch into finding solutions, because that's what we do for the day job. There was a piece on the radio this morning, a suggestion that the Treasury may be reconsidering the position for people, let's say, over 80, because they haven't got time to necessarily to do the planning and to survive 7 years. But apparently the Treasury has denied that. So we're getting into this horrible world of post-budget speculation, when I was hoping the budget was an end to all of the weeks of speculation in the run-up. But now we're speculating all over again. So let's I guess just sit tight for a little while, because we have got the whatever it is, 15, 16 months until the changes come in for people to have the rules, go through the consultation, think about it, and come to the answer that best suits them and their family. And the one other thing I was going to say was, in a narrow sense, and this again is coming back to the inheritance tax, an industry that I think is going to come back into play is insurance against the tax should you, I suppose, one, if you're making a pet and you want 7-year term cover against the tax liability, you're not surviving the 7 years, or generally whole of life, or in whatever's appropriate for your circumstances for insuring against inheritance tax. And I think for the right kind of cover, I've seen some quotes that are actually not as scary as you might think, depending on what your circumstances are, but not our area of expertise. But
Well,
something,
I think someone did say about the cost of it, depending on how old you are, is the cost of insurance if you actually put the money aside and save that and then use that to pay. But then obviously if you've got a cash pot, you might have 40%
yeah,
tax, and yeah, it's sort of, you go round and round in circles.
can. But all of these things, the joy of being an advisor, Leo. So that's
Yes, I know. And don't we love it?
we do, we
But
do. But the sad
we
thing is
do
that
genuinely love it. We're
I
very lucky.
know, yeah, we shouldn't admit to that. We'll get that bit edited out.
Well, hopefully that's provided our listeners with just a few things to think about if you're considering making gifts this festive season, or more generally, say, following the budget. So thank you, Mike, for joining me today. We work with a wide range of clients. Many are UK based and many live overseas but have interests here, whether that's property, business interests, or investments. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. If you'd like to find out more about the services we can offer at Safri, please visit our website at www.safri.com. However, it is important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice based on your individual circumstances. Thank you for listening.